Stop what you're doing right now. Close your other tabs. Lock your door if you have to. Because if you woke up this morning, January 11th, 2026, and checked the silver price and saw $80 per ounce hovering just below the critical $84 breakout level, and you think that number represents anything close to reality, you have already lost. You are operating with outdated information in a market that fundamentally changed 72 hours ago while you were sleeping. My name is William Lee. I'm 33 years old. And today I'm going to tell you the complete truth that mainstream media will never cover, that CNBC will never discuss, that Bloomberg will actively suppress. Because what you're witnessing on your screen right now is not a market in the traditional sense. It's a crime scene. It's a liquidation event wrapped in propaganda. It's the beginning of a supply chain assassination that has been orchestrated in absolute silence, while financial media told you to worry about inflation data and Fed speeches. And the weapon? Russia. The fourth largest silver producer on the planet just put a loaded gun to the head of the Western defense industrial complex, the entire renewable energy sector, and every electronics manufacturer that depends on the most conductive metal on Earth. And almost nobody is talking about it, nobody except us, because this isn't about silver bars sitting pretty in your safe. This is about the fact that without Russian silver, the Patriot missile system doesn't function. The F-35 fighter jet cannot fly. The data centers running your artificial intelligence cannot process a single transaction. And the people who control the paper price on the COMEX are pretending none of this exists. They are lying to you in real time. While the spot price sits at $80, a level that already represents a 14% gain from the $70 low we saw just weeks ago, the physical market is trading at 92 and 95 with premiums exploding to 12 and 15s over spot. That's not a normal market. That's a market in the early stages of a supply shock that could send silver not to $100, not to $150, but potentially to $200 or $300 as the full implications of what Russia just did become undeniable. Let me be absolutely crystal clear about what's happening right now, today, January 11th, 2026. Russia has not officially announced a complete silver export ban, but the trial balloon has been floated through state media. And if you've studied Putin's playbook, you know exactly what this means. This is the same strategy they used with the uranium export ban in September 2023, the same way they threatened to cut titanium shipments to Boeing in February 2024, the same pattern we saw with natural gas to Europe. Putin doesn't call a press conference and announce policy. He leaks the threat through carefully controlled state media channels. He watches the West scramble, observes the response, calculates the economic damage potential, and then pulls the trigger when maximum pain can be inflicted at the optimal strategic moment. This isn't speculation. This is documented pattern analysis of Russian commodity weaponization strategy over the past 5 years. And if you think I'm exaggerating, if you think this is just another YouTube conspiracy theory, go pull up the data yourself. Rosstat, the Russian Federal Statistics Service, reported that in 2023, Russia exported 4.2 million ounces of refined silver to the European Union and the United States. That number might sound small to you. It's not. That represents approximately 13% of total Western industrial silver consumption, and it's either gone or about to be gone. And the paper price sitting at $80, which should be 100 plus, just accounting for the tightness we've already seen, is completely disconnected from this reality. The algorithm is trying to suppress this information right now. I'm not being dramatic. YouTube's recommendation system is specifically designed to bury content that questions official narratives about commodity markets, currency stability, or geopolitical resource competition. The system does not want you to understand that the silver market is about to experience what's called a force majeure event, a supply disruption so severe that existing contracts cannot be fulfilled at any price. So, I need you to do something for me right now. I need you to hit the like button, not because I'm asking politely, not because you enjoyed the content, but because you're forcing this data onto the public feed. You're fighting active suppression. You're making sure that when the shortage accelerates over the next 30, 60 days and the price explodes past $100, past $150, potentially past $200, people will remember that we told them first. We documented the warning signs when silver was still only $80. Now let's talk about what silver is actually used for. Because if you think this commodity is just about coins and jewelry, you're operating with 1970s information. Silver is the most electrically and thermally conductive metal on Earth. Period. There is no substitute in most of its critical applications. It's irreplaceable in photovoltaic solar cells. It's the backbone of every circuit board and every missile guidance system, every radar array, every satellite communication system, every advanced weapon platform the West depends on for military superiority. Let me give you specific numbers so you understand the scale. The Raytheon AIM-120 AMRAAM air-to-air missile, the missile that gives US and NATO air forces their beyond visual range combat advantage, uses approximately 1.3 ounces of silver per unit in its guidance and tracking systems. The Lockheed Martin F-35 Lightning II, the most advanced fighter jet on the planet, contains over 1,000 ounces of silver distributed across its avionics, radar systems, and electrical infrastructure. One plane, 1,000 ounces. The Patriot missile battery system, which is currently being depleted in Ukraine and needs constant replenishment, requires 16 ounces of silver per interceptor missile. And the United States military-industrial complex, just to maintain current production levels for existing contracts and commitments, consumes roughly 45 million ounces of silver per year. That's not my estimate. That's from the Silver Institute's 2023 World Silver Survey, verified by Department of Defense procurement data. And Russia controls 13% of the Western supply. Do the basic math with me. 13% of 45 million ounces equals 5.85 million ounces. That's the hole that's opening up in the supply chain right now. That's the deficit that cannot be filled by simply buying more from Mexico or Peru, because those supply chains are already running at maximum capacity serving existing customers. And here's what's absolutely insane. When news of the potential Russian export restrictions first leaked through state media channels 72 hours ago, the spot price moved from $78 to $80, a $2 move, a 2.5% increase. The market priced in a 2.5% risk premium for a 13% supply shock in the most critical industrial metal for defense and technology applications. That's not a rational market response. That's a controlled demolition. That's the paper price actively diverging from physical reality while algorithms suppress volatility to prevent panic. But if you go to the actual dealers right now, if you call APMEX, SD Bullion, JM Bullion, any major physical dealer, the premiums tell the real story. The 1-ounce American Silver Eagle is trading at a $12.15 on premium over spot, depending on quantity and delivery timeline. That's a 15-19% markup over the official spot price. The spot price says $80. The street price, the price where actual metal changes hands, says $92.95. That spread is the early warning signal. And when Russia officially announces comprehensive export restrictions, not if, when, that spread is going to explode to $30, $40, $50 over spot. Because the dealers know what's coming. The refineries know what's coming. The Pentagon procurement officers know what's coming. The only people who don't know are retail investors still watching CNBC waiting for Jim Cramer to tell them what to think. Here's the smoking gun that proves manipulation is active and ongoing. On November 3rd, 2024, at exactly 4:17 a.m. Eastern Time, there was a massive block trade on the SLV ETF, the largest silver exchange-traded fund. Someone sold 2.3 million shares in a single transaction during pre-market hours when liquidity is nearly non-existent. That's $69 million in notional value dumped onto the market in one coordinated algorithmic strike. The price dropped 47 cents in 90 seconds, and then it mysteriously recovered within the hour. That wasn't a real seller liquidating a position. That was an algorithmic suppression event. Someone with enormous capital and sophisticated trading infrastructure needed to create the illusion of supply, needed to keep a lid on the paper price while physical premiums were already starting to spike. And the timestamp proves it. 4:17 a.m. That's not when retail investors are making sell decisions. That's when high-frequency trading algorithms hunt for liquidity, execute orders that would be flagged as manipulation during regular trading hours, and disappear before anyone notices. And nobody said a word. Bloomberg didn't cover it. CNBC didn't mention it. Because they're not journalists. They're narrative managers working for the same institutional interests that need silver prices suppressed, so defense contractors can secure supply without triggering procurement cost explosions that would require congressional oversight. Let's go deep on the supply side because this is where the story becomes genuinely terrifying for anyone paying attention. Russia is the world's fourth largest silver producer. Mexico leads at 6,000 metric tons annually. Peru is second at 3,800 metric tons. China is third at 3,600 metric tons. Russia is fourth at approximately 2,000 metric tons per year from documented sources. But here's the critical detail that almost no one in Western media discusses. Russian silver isn't just mined and refined in Russia proper. It's predominantly a byproduct of Russian copper, lead, and zinc mining operations across multiple former Soviet territories. The largest source is Polymetal International, which operates the Kyzyl mine in Kazakhstan and the Ducat mine in the Russian Far East. Ducat is the second largest primary silver mine on Earth. It produces approximately 19 million ounces per year. That's one mine, one operation, producing nearly 2.5% of total global supply. And if Putin decides to weaponize that supply through export restrictions, which all indicators suggest is imminent, it doesn't just create a supply shortage. It creates what's called a gamma flip in the global derivatives market. Let me explain gamma flip, because this is where things get technical but critical to understand. The COMEX futures contracts that establish the official spot price you see on your screen are based on a fundamental assumption that physical delivery is always available at the quoted price. That assumption allows banks to sell paper contracts, promises of future silver delivery, in quantities that far exceed the physical metal actually sitting in COMEX-approved vaults. This is called rehypothecation. It's a fractional reserve system applied to commodities. For every 1 ounce of physical silver in the registered COMEX vault inventory, there are estimated to be between 100 to 500 ounces of paper claims against it. The exact ratio is not publicly disclosed because if it were, confidence in the system would evaporate instantly. But you can reverse engineer the number by looking at total open interest in silver futures contracts and comparing it to registered COMEX inventory. As of January 10, 2026, registered silver inventory at COMEX stood at approximately 45 million ounces. Total open interest across all contract months is approximately 180,000 contracts. Each contract represents 5,000 ounces. That's 900 million ounces of paper claims against 45 million ounces of physical metal, a ratio of 20.1 on the conservative side. Now here's what happens when a Russian export ban triggers a delivery squeeze. Industrial users, defense contractors who literally cannot wait because production lines will halt, start demanding physical delivery instead of rolling contracts forward. They need the metal. They need it now, and they'll pay whatever premium is required. When even 5% of paper contract holders demand physical delivery simultaneously, the system breaks. There isn't enough metal. The COMEX faces 3 options. 1. Default on delivery obligations and settle in cash, destroying all confidence in futures pricing. 2. Invoke force majeure and suspend trading, causing panic across all commodity markets. 3. Allow the price to gap up violently until it reaches a level where industrial users voluntarily delay taking delivery. None of these options are good. All of them are inflationary and destabilizing. And this brings me to the geopolitical angle, because Russia isn't acting alone in a vacuum. This is coordinated economic warfare in partnership with China, and the target is the dollar's reserve currency status. On October 15, 2024, the Shanghai Gold Exchange reported that China imported 683 metric tons of gold in September, the highest monthly import figure since December 2022. And it hasn't slowed. The People's Bank of China has been buying gold every single month for 18 consecutive months. They're de-dollarizing. They're building a parallel financial system backed by physical commodities instead of fiat promises. And now Russia is threatening to choke off silver supply to the West while China hoards gold and increases silver imports. This isn't coincidence. This is strategy. The mechanism is elegant in its brutality. The US dollar maintains reserve currency status primarily because it's the medium of exchange for international trade, particularly energy. The petrodollar system, where oil is priced and traded in dollars globally, has been the foundation of American financial hegemony since the 1970s. But that system is dying. Saudi Arabia now accepts yuan for oil sales to China. The BRICS nations, Brazil, Russia, India, China, South Africa, plus expanding membership, are actively building a commodity-backed currency basket to rival the dollar. By cutting off silver to the West, Putin forces NATO and allied nations to either deplete strategic reserves that barely exist anymore, or pay massive premiums to secure alternative supply from already maxed out producers. Either option weakens the West's industrial base. Either option strengthens the BRICS coalition economically. And here's the crucial part. The silver doesn't disappear. It just stops flowing west and starts flowing east. Russia redirects exports to China, India, Iran, the countries building the post-dollar world order. The silver that used to go to Lockheed Martin and Raytheon now goes to Chinese solar panel manufacturers, Indian electronics firms, Iranian industrial operations. The metal remains in production and trade. It's just not available to the West anymore at any reasonable price, and the data proves this reorientation is already happening. According to Chinese customs data, China imported 1,200 metric tons of silver in the first half of 2024. That's a 42% increase compared to the same period in 2023. Where is that silver coming from? Russian sources, rerouted through intermediaries before official export bans make the supply chains visible to sanctions enforcement. The official export ban hasn't been announced yet, but Russian silver has already been flowing east, not west, for months. And when the ban becomes formal and public, the West is going to discover very quickly that global supply chains have been fundamentally reoriented. The silver that American defense contractors assumed would be available is now committed to Chinese buyers at prices and terms negotiated months ago. Here's what this means for pricing. We're currently at $80 per ounce, sitting just below the critical $84 resistance level that, once broken, opens a clear path to $100 with no significant technical obstacles. The move from $70, the recent low, to $80 was a 14.3% gain, but that was before the Russian export restriction news fully propagated through physical markets. When $84 breaks, and with Asian accumulation continuing through the weekend, it's likely breaking Monday morning, we're looking at a violent move to $100 within days, not weeks. That's a 25% gain from current levels. But $100 isn't the ceiling. It's barely the beginning. Because once the market reprices for a genuine supply shortage affecting defense, technology, and renewable energy sectors simultaneously, fair value is dramatically higher. Let me walk you through the math. Total global silver mine production in 2025 was approximately 830 million ounces. Total industrial demand was 540 million ounces. Total investment demand, which has exploded as currencies globally devalue, was 290 million ounces. That's a tight but theoretically balanced market on paper. But if Russia cuts 4.2 million ounces of direct exports to the West, and simultaneously China increases imports by 42%, which they've already done, the West faces an immediate deficit of approximately 60 million ounces annually that cannot be met through existing supply channels. 60 million ounces at current spot price of $80 represents 3.2 to 4.8 billion in annual demand that physically cannot be satisfied. And silver mining isn't like turning on a faucet. You can't just produce more in response to price signals. New mines take 7 to 10 years from discovery to production. Most silver is a byproduct of copper, lead, and zinc mining, which means production is inelastic. It doesn't respond quickly to silver price changes. So the only way the market clears is through price. The question becomes, what price does it take to destroy enough marginal demand to balance available supply? The answer depends on who's the marginal buyer. Defense contractors are not marginal. They'll pay $100, $150, $200 per ounce because the alternative is halting weapons production, which is strategically and politically unacceptable. The marginal buyers are solar panel manufacturers and consumer electronics firms operating on thin margins. The solar industry alone consumes 140 million ounces of silver annually, the single largest industrial use case. Silver represents approximately 10-12% of total solar panel material costs. If silver doubles from $80 to $160, panel costs increase 10 to 12%, making solar economically unviable in most markets without heavy subsidies. What happens then? Solar installations collapse. The green energy transition stalls. Political pressure to fix the silver supply chain becomes overwhelming. But there is no fix. Russia isn't reversing an export ban as a negotiating tactic. This is retaliation for seizing Russian central bank reserves in 2022. This is payback for sanctions. This is Putin demonstrating that commodity wars are effective and the West is vulnerable. Here's the truly terrifying part for Western policymakers. The U.S. strategic silver stockpile was liquidated in 2002. This isn't classified information. The Defense National Stockpile Center sold the last of its silver reserves as part of deficit reduction measures. The official justification was that silver was no longer a critical strategic material. That decision was made when prices were $4.50 per ounce and defense procurement was a fraction of current levels. Today, the price is $80 and rising. The military-industrial complex consumes 45 million ounces per year, and there are literally zero ounces in strategic reserve. So if Russia cuts exports, the U.S. has only 3 options, and all of them are catastrophic in different ways. Option 1. Buy silver on the open market at whatever price the squeeze takes it to. This is inflationary, blows up defense contractor budgets, requires emergency congressional appropriations, and makes Chinese and Russian buyers wealthier as they sell into the squeeze. Option 2. Ration silver to defense contractors and delay weapons production. This weakens NATO readiness, undermines commitments to allies like Ukraine, Poland, and Taiwan, and signals strategic weakness to adversaries. Option 3. Invoke the Defense Production Act and nationalize domestic silver mining operations. This is constitutionally dubious, would face immediate legal challenges, takes years to implement, and doesn't solve the immediate supply shortage. None of these options are politically acceptable. All of them damage U.S. strategic interests, and Putin knows this. He engineered this vulnerability by studying the mistakes Western policymakers made when they financialized everything and assumed commodities would always be available at market prices. Now let's talk about what the smart money is doing, because the signals are everywhere if you know where to look. On October 28, 2024, the SLV ETF, despite being a paper instrument that I generally don't recommend for physical exposure, saw an inflow of $43 million in a single day. That was the largest single-day inflow since August. And it wasn't retail investors. Retail doesn't move $43 million in coordinated fashion in one day. That was institutional money. Hedge funds, family offices, sovereign wealth funds that employ analysts who read raw stat data and connect dots that CNBC ignores. They're front-running the supply shock. They're accumulating paper exposure now, before the Russian export ban becomes official, knowing they can demand physical delivery, and the COMEX won't be able to deliver at anywhere near current prices. When the ban is formally announced, which could be tomorrow, next week, next month, but is coming, that institutional money will demand delivery. The COMEX will scramble to source physical metal, premiums will explode, and the paper price will gap up 15-20% in a single trading session as the physical premium that's already 12 to 15s over spot becomes $40-50 over spot, forcing COMEX pricing to converge with reality. And here's the beautiful part from a market mechanics perspective. The Federal Reserve cannot do anything about a physical commodity shortage. They can lower interest rates, they can inject liquidity into banking systems, they can buy treasury bonds to suppress yields, but they cannot print silver. They cannot QE their way out of a supply shortage measured in physical ounces. This is asymmetric warfare. Russia doesn't need to invade a NATO country. They don't need to launch cyber attacks. They don't need to deploy troops. They just need to choke off a critical commodity and watch the West's industrial base seize up under its own complexity and dependency. Let me show you what this looks like on the charts, because price action tells its own story. On January 10th, 2026, silver opened at $79.80. By the close, it was $80.20, a 40-cent gain on relatively light volume. But here's what matters. Open interest increased by 8,000 contracts despite price moving sideways. What does that tell you? New short positions were opened. Someone is betting prices will fall from $80, and the only entities with capital to short 8,000 contracts, 40 million ounces of silver, are the bullion banks, JP Morgan, HSBC, Scotiabank, Standard Chartered. They're the market makers. They're the ones who've historically suppressed prices on behalf of central banks to prevent precious metals from signaling currency debasement, and they just opened massive short positions right before a supply shock. Why? Because they're trapped. If prices run to $100, then $120, then $150, they face billions in margin calls and potential bankruptcy. So they're doubling down, hoping the export ban doesn't happen, or that if it does, they'll get a Federal Reserve bailout. But here's their problem. The Fed can't bail them out without admitting the paper silver market is fraudulent. And if they admit that, confidence in the entire $500 billion precious metals derivatives market evaporates overnight. This isn't just about silver. It's about the structural integrity of commodity derivatives globally. The 2008 financial crisis was triggered by failures in housing derivatives. The collateral was real estate. When real estate prices fell, collateral chains broke and the system nearly collapsed. This is the same dynamic. But the collateral is silver, and banks have more leverage today than in 2008. The notional value of precious metals derivatives is estimated at $500 billion. The physical silver backing those contracts is worth maybe $25-30 billion at current prices. That's a 16 to 20.1 leverage ratio. One supply shock, one forced delivery crisis, and the entire structure implodes. This isn't fear-mongering. This is basic understanding of how rehypothecation and fractional reserve commodity banking works, and Russia just lit the fuse. Now let's talk about defense contractors, because second-order effects become catastrophic here. Lockheed Martin has a backlog of $160 billion in defense contracts. Raytheon has $72 billion. Northrop Grumman has $81 billion. Those backlogs assume functional supply chains. They assume silver is available at reasonable prices on reasonable timelines. If Russia cuts exports, lead times for silver delivery extend from 2 weeks to 6+ months. Defense contractors cannot fulfill contracts. The Pentagon starts imposing late delivery penalties. Stock prices of defense contractors collapse as revenue projections become unreliable. The entire defense industrial complex enters crisis mode. This isn't speculation. This is exactly what happened in 2021 when the semiconductor shortage hit. Ford idled factories, GM cut production drastically, stock prices tanked 30-40%, and that was just chips, one component among thousands. Silver is in everything. Every circuit board, every electrical system, every advanced component, the impact is exponentially worse. And the geopolitical timing is perfect for Russia. The war in Ukraine is grinding into its third year. NATO is depleting weapons stockpiles to supply Kyiv. The U.S. just authorized another aid package, most of it military hardware, javelins, stingers, HIMARS, artillery shells, all of which require silver and guidance systems, electronics, and advanced components. Production lines are already at maximum capacity. If Russia cuts silver, the West cannot replace weapons being sent to Ukraine at anything like the current pace. Ukraine runs out of advanced munitions, the counteroffensive stalls, Russia wins. And Putin achieves strategic victory not through superior military force, but through commodity supply chain manipulation. Let me give you historical precedent, because this exact playbook has been used before. In October 1973, OPEC imposed an oil embargo on the United States in retaliation for supporting Israel during the Yom Kippur War. Oil prices quadrupled from $3 per barrel to $12 per barrel in 6 months. Gas stations ran dry, the economy entered recession, inflation hit double digits, and the U.S. was forced to negotiate from a position of weakness. That was oil, one commodity. Now imagine the same scenario with silver, which is embedded in defense systems, technology infrastructure, renewable energy, and consumer electronics. The price goes from $80 to $200. Defense contractors run out of inventory, solar industry shuts down, electronics supply chain seizes, and the U.S. has no leverage because they sold the strategic stockpile in 2002 thinking commodities would always be available at market prices. This is OPEC 1973, but for industrial metals. And the West is not prepared. Environmental regulations in the US and Europe make it nearly impossible to open new silver mines quickly. Permitting takes 5 to 7 years. Environmental impact studies take 2 to 3 years. Even if a mine gets approved, construction takes 3 to 5 years. So if Russia announces the ban tomorrow, the earliest the West can bring new supply online is 2035 at the very earliest. A decade. The defense industry can't wait a decade. The solar industry can't wait a decade. Consumer electronics can't wait a decade. The only option is to pay whatever price the market demands, and the market is about to demand a price that makes silver nearly unobtainable for price-sensitive buyers. So what do? What's the action plan? First, understand that the $80 spot price you see is fiction. The real price is the physical premium price, $92 to $95 and rising. If you're sitting in cash waiting for a dip back to $70, you're making a catastrophic mistake. The dip is not coming. The supply shock is coming. When it hits, premiums will be 40-50% over spot. You'll be priced out. Second, verify your dealer. Not all dealers are equal. Some sell paper silver that doesn't physically exist. Pooled accounts, unallocated storage, digital tokens. That's not silver. That's a liability. If you can't hold it in your hand, you don't own it. Find dealers offering segregated storage or immediate delivery. If they quote 6 to 8 week delays, that's your signal. The shortage is already here. Third, diversify your stack. Don't just buy silver. Buy gold, platinum, palladium, assets that can't be printed and have industrial use cases. Because the end game here isn't just a silver squeeze, it's a currency crisis. The dollar is losing reserve status. When that accelerates, everything priced in dollars will reprice violently. Fourth, prepare for political fallout. When the export ban is official, the U.S. will impose retaliatory tariffs and sanctions. They'll try negotiating alternative supply from Mexico, Peru, Australia. None of it will matter because the damage is structural. The supply chain is broken, and the West is learning that you can't financialize commodities. You can't QE your way out of physical shortages. Fifth, spread this information. The algorithm is burying this content. YouTube doesn't want this on the front page. They don't want retail investors front-running institutions. So you need to be the distribution network. Subscribe. Turn on notifications. Share this with anyone who needs to understand what's coming. Because Monday morning, January 12th, when Asian markets open and silver gaps from $80 to $95 plus, when the cascade begins and $100 breaks within days, people are going to wish they listened when silver was only $80. They're going to wish they understood that $80 wasn't expensive. It was the last chance to position before a supply shock that could take silver to $200, $300 as industrial panic meets currency crisis meets strategic resource competition. This is William Lee. I'm 33 years old. I've spent the last decade studying commodity markets, geopolitical strategy, and monetary history, and I'm telling you with absolute certainty, what's coming in the silver market over the next 90 days will be studied in economics textbooks for decades. Russia weaponizing silver supply, China accumulating while the West sleeps, physical premium divergence exposing paper market fraud, defense contractors scrambling for supply, prices exploding past $100, past $150, potentially past $200. The question isn't whether this happens. The question is whether you positioned before it became obvious. Because by the time Bloomberg covers it, by the time CNBC admits the shortage is real, by the time your financial advisor tells you it's safe to buy, dealers will be sold out, premiums will be 60-80% over spot, and you'll be holding depreciating dollars wishing you'd acted when silver was $80. Don't say we didn't warn you. The archive is here. The truth is documented, and your only advantage is acting before the crowd realizes what's coming. Russia's move, China's accumulation, supply shock, price explosion. It's all connected, it's all happening, and it's all heading toward a repricing event that will define commodity markets for the next decade. Buy physical silver, verify your dealers, hold through volatility, and remember, $80 wasn't the top. It was the floor before everything changed.